We're back in the office, Mike. Just in time for Omicron?
For Omicron.
Excellent. The November update. November, it started off with such promise. It was going to be a November to remember. And sure wasn't, I guess, right? A couple of big headlines this month. Omicron, the Fed. Those are probably the two largest headlines. And then fiscal spending, Jerome Powell being renominated, etc. So take us through the Omicron headline.
Yeah, Omicron, don't know a whole lot. No, it is a variant of concern, primarily because it is very different in terms of its mutations. Some of those mutations are alarming. Don't know if it's more transmissible. Don't know if it's more deadly. We do know it's already basically everywhere. And so you just think how this plays out. If it does turn out that this is ultimately more mild and more transmissible, that could actually be bullish, as it would sort of perpetuate this narrative that this whole situation is evolving from a global pandemic to a global endemic. And if it's an endemic, policymakers shouldn't be resorting to lockdowns, and we should all sort of learn to live with it.
One thing for sure we know about it is people do not know how to pronounce it properly.
Yeah.
It is Omicron.
Yeah.
Okay, the Fed. Lots of stuff going on with the Fed and Jerome Powell.
Yeah, the market got more Powell Bell. So Jerome Powell renominated. Lael Brainerd, who was the only other real candidate, is going to serve as vice chair. So the market took that news in stride. The only real disruption to markets was Jerome Powell's testimony right after Thanksgiving, where he signaled that the Fed could wrap up its tapering of asset purchases even quicker than they previously stated. And previously they stated that it was going to be even quicker than they previously stated. So basically the taper timeline, it could be over by March. And then that's only an issue in our view, because now that means the market is pricing in more interest rate hikes next year. Because once the taper's done, interest rate hikes can begin.
Can you have too much Powell Bell?
Well, yeah, we'll ultimately see. He's talked a big game about rate hikes next year. The market is pricing in a lot of rate hikes. It's big talk, but ultimately the Fed has a habit of talking a lot of rate hikes into expectations and then under-delivering. So,
all right, let's turn to the fiscal side. We've got the concept of, which you'll hear about in our outlook, the Ratchet effect.
Yeah. So we got the infrastructure bill passed, and the social spending and climate change bill, it's been called, the Build Back Better bill, that should be up for vote here shortly, running into, the debt ceiling debate again. So a lot of stuff coming up on the congressional calendar here in December. We'll be hearing a lot more about that. But we think, the infrastructure bill and this Build Back Better plan, the Build Back Better bill, are very much in line with the idea of the ratchet effect, that even though we're not going to get the same level of fiscal stimulus that we got these last 2 years, which was so great for markets because it pumped more money into the system than we've ever seen before, we're not going to get that, but fiscal spending is going to be very hard to walk back. And policymakers are going to find reasons and excuses to continue to ratchet up fiscal spending even long after the original crisis has faded from memory. And so this is emblematic of that.
All right, so yes or no? Holiday rally?
Tough to say. Definitely don't think there'll be a holiday rally in bonds. Yields are already very low, so if money is going to go anywhere, equities certainly look more attractive.
So let's first go through the grid for the month of November and look at the returns.
Looking at asset class returns, the column furthest to the left there is just for the month of November. So you can see a lot of red numbers across the board. Almost all of those negative returns came in the last 3 trading days of the month, and were spurred by the Omicron variant, as well as Jerome Powell's testimony in Congress. So slightly negative returns for the S&P 500, higher beta areas of the equity market, things like small caps, down more significantly, foreign equities down as well. And then within the fixed income space, interest rates were rising for most of the month, putting some downward pressure on bond prices. And then once again, in those last 3 days of the month, longer term interest rates falling, more of a risk off type of tone. And so you saw high quality bonds eke out a positive return. Commodities had a rare negative return month. Haven't seen any of that yet this year. This is the first month that we've seen commodities negative. A lot of that related to, one, Omicron fears and what impact that might have on the global reopening, as well as a coordinated effort for a number of countries to release petroleum from their strategic reserves. So that put some downward pressure on energy prices as well. But putting this all in context, year to date, it's still been an excellent year for diversified portfolios. S&P 500 up 23% year to date. Probably going to end the year pretty happy with the results. Yeah,
let's look at the details of that sort of month in review on the S&P side. I mean, as we could say, it was like things were great. Everyone was happy. We were having a great month, and then this first drop. I mean, is this all related to Omicron? Because really, where the first news came on Omicron was a little bit later.
Mm-hmm. Yeah. The S&P throughout the month, it was reaching all-time highs as late as November 19th. Then got into some volatility early, the 22nd, 23rd, right before Thanksgiving, saw some volatility. And, nothing different from what we were seeing earlier in the month. Nothing really unique until the day after Thanksgiving, which is when the Omicron variant was identified and named as a variant of concern. There you saw a big, steep decline. Then once again, investors were really buying the dip as we got through the weekend and into the last couple days of the month. And equity markets were rallying. And then Jerome Powell said a few things in a testimony to Congress that spooked markets again and thought that, maybe the Fed is going to be tapering asset purchases much faster. So all in all, what you get is the S&P from its all-time high to the end of the month down 3.7%, which, in a normal year, you don't even blink an eye at that,
right?
Or bat an eye at that. But, this year, that seems like a big downturn.
So what's the reaction to what Powell said? Why such a sort of immediate downturn here?
Yeah, so and that was intraday. So that was as he was speaking. The first thing he said is we're going to retire the word transitory. And if you take that out of context, there's more context around that. It was basically that, the Fed meant that to mean something that apparently everyone in the marketplace doesn't agree with. The marketplace was taking it as short term, and that's not what they ever meant. So they're just going to stop using the term. But that was misconstrued as, all right, well, you've been using the word transitory to justify why you're not being so aggressive in hiking rates or tapering asset purchases despite inflation, because inflation is transitory. So if you remove that, are you now going to be more aggressive in tightening? So that was the first thing that was said. And then the second thing was in relation to comments about inflationary fears and how hot inflation was running. And he commented that they could potentially wrap up the taper a couple months sooner. So
what's the downside to that? I mean, aside from the psychology of it.
Yeah, so at face value, that doesn't mean a whole lot. The market is basically giving the Fed the taper. Say, if you're going to do the taper and you want to get it done middle of next year, say you want to get it done, 2 months sooner than that in March next year, that's fine, because even when you're done tapering, your balance sheet's going to be about $9 trillion. And while you won't be adding to that every month, you'll be reinvesting $9 trillion worth of securities every month.
Yeah.
So we'll give you the taper. That's fine. You're just taking the foot off the gas pedal. But why it causes an issue with the markets is because the expectation then is as soon as you're done tapering, you're going to start hiking interest rates. And that is what the market doesn't like.
Right.
And so in a way, when this happened, what you saw was long-term interest rates fall, equities fall, short-term interest rates move up. So the market effectively is raising short-term interest rates for the Fed.
Right.
Obviously not raising the federal funds rate, only the Fed can do that, but raising other short-term interest rates that the market has control of. So the Fed's talking a big game. You know?
And we saw mortgage rates move higher.
Right.
So the add-on effect there. But the reality is there's probably no impact by them actually speeding up the taper to the financial market. So let's move on to Omicron. The interesting thing during this whole sell-off was the volume was very low, especially the day after Thanksgiving. I mean, the volume was unbelievably low. So you can't really read a lot in there. And I think the VIX has failed 3 times now at 30. So it's really not signaling there's something really wrong here.
Right.
However, we are in the first inning. We're N equals 2 on the case counts for Omicron as we sit here today. And let's talk through what that means and what impact that might potentially have and why that's causing some volatility to remain elevated.
In our view, the primary fears that the market is reacting to, one is we don't know that much about Omicron in terms of transmissibility, how deadly it is, if it's more dangerous than other variants. But we know that the reaction function of policymakers to shut down travel and reinforce restrictions, that is what the market is reacting to. And that has been negative. So that would be the first thing. And then the second thing that they're reacting to related to the Omicron is just basically fearing the worst because of what they're seeing in South Africa.
Let's dig into that a little bit.
Yeah. So this chart, we show 7-day moving average case counts, and these are all for each country scaled relative to each country's peak in cases. And so you can see these waves come through, alpha and beta variant in the UK and South Africa in fall and winter 2020 to 2021. Then you see the rise in Delta this past summer. And then Omicron, too soon to tell.
Right.
The only lot of countries have now reported cases of Omicron. Basically, everyone that knows how to sequence COVID cases is reporting Omicron. So it's out there. It's everywhere. The only where we know it's the dominant variant is in South Africa. And so that's the purple line. It's tough to see. South Africa was reporting very low case counts prior to this recent rise. And now they're seeing cases sort of double every day. And they've seen Omicron crowd out all other variants. So the fear is that this is more transmissible, just based on that evidence. It hasn't been verified yet.
Right.
Omicron made its way as a variant of concern, not because of evidence of increased transmissibility, because we don't know that yet, but just because the number of mutations were concerning. So it was sort of guilty until proven innocent, if you will.
Right.
So that's the concern. What's going on in South Africa? Is it more transmissible?
So is the market reaction more a factor of Omicron itself or the reaction function to it?
The reaction function by policymakers, that's the primary fear. I mean, that obviously has consequences for companies. Airlines, anything tied to a reopening theme, there are consequences for those stocks. So that's going to cause a downturn. The other way that this factors in is just sentiment. We've talked a lot about confidence versus sentiment. We don't think this is going to do much for consumer confidence.
Right.
But it can continue to weigh on consumer sentiment as we head into the holiday season. So, whether this is more transmissible or virulent or not doesn't really matter. The headlines are scary, and rightfully people are going to voluntarily change their behavior. So the more interesting thing for us is, a lot of this is just reporting the news. We don't know much. But what is this emblematic of? Sort of how does this evolve going forward? Right? Because we know this thing is going to keep mutating. And so if it turns out that Omicron is more transmissible, but also more mild than past variants, that there could be a bullish undertone to that.
It's a pretty good
for
outcome,
markets.
Right?
For markets, right? Because that would sort of be another feather in the cap of the narrative that this is moving from a global pandemic to more of a global endemic, meaning it's going to be with us. The vaccines are going to have to be adapted as the virus adapts, but this thing will ultimately end when everybody either gets it, recovers from it, or is vaccinated. And if you have something that's mild but very transmissible and it's already everywhere, maybe that speeds up that process.
Yeah, I think that's the hope, is that it's speeding up so fast that it'll just wear itself out and become a common cold eventually.
Right. So still a lot we don't know. That's definitely the hope. And if you study viruses in the past, that's generally how they evolve. As they evolve, they become more transmissible, generally less mild, so they can survive even as
More
things
mild,
like vaccines or I'm sorry, more mild, even as things like vaccines come about. So that's the hope. And that could be bullish. That could be a bullish setup for next year.
So the Fed's response, how much of what Powell has said is embedded in with the Omicron situation behind it? Because did that change much as we look at the next chart, sort of the outlook for rate hikes?
Yeah, this is very interesting. So this chart is what the overnight index swap market, which is basically a market for expectations of overnight interest rates, what that market is saying the federal funds rate is going to be 12 months from now. So this is what the market thinks in terms of rate hikes over the next 12 months. And we'll talk about the trajectory of this chart. But if you focus all the way over to the right, you can see right before Omicron, the expectation was the federal funds rate 12 months from then would be 82 basis points. Because, okay, the Fed's reacting to inflation, they're going to taper quicker. That means they're going to hike more. They're going to get more hikes in the next 12 months. And that's pretty hawkish. I mean, that's over 3 rate hikes in 2022. Yeah. They're going to be busy if they get that done, right? And then you see the expectations for rate hikes fall off pretty dramatically, and that was Omicron. Okay, we got another variant. This is not good. The Fed, it gives them the ability to say, we're going to be cautious. We're not going to hike as quickly. The economic recovery is more fragile. But then right after that is when Powell was on Capitol Hill making comments like, hey, we're going to wrap up our asset purchases maybe a couple months sooner than previously said, and we should retire the word transitory. So Omicron is naturally putting, you would think would put downward pressure on rate hike expectations.
Right.
But Powell is out there, on Capitol Hill just saying the exact opposite. So he seems pretty committed to talking a big game in terms of rate hikes, even though Omicron gave him an opportunity to basically change his tune. It's tough to say how much of what he said was written in advance of this or how it may evolve going forward.
It still might give him a chance to do something.
Right. But it definitely gave him a chance, and he didn't take it. He did the opposite.
Or perhaps he's more worried about inflation than they're leading on to be. And he really knows that he has to, in the face of potential more fiscal stimulus in a response to this, he has to be more aggressive.
Yeah, there's that. There's that as well. You could also say, well, there's no way they can hike rates right now because they're still buying, $105 billion a month in treasuries and mortgage-backed securities. So how can you get the effect of a rate hike right now when inflation is hot?
Right.
Well, you talk a big game, and you have markets price in expectations for higher short-term interest rates, and you have short-term interest rates go up. So now it's like you get a free pass. The market can do your monetary policy for you right now. Talk as big a game as you want. And then you set yourself up next year. You promise a lot of rate hikes, and then you just underdeliver.
Absolutely.
Yeah.
So let's shift gears and talk about stimulus, because there's been records amounts of stimulus. This next chart we have sort of just captures the last year or so of it, but also, we're talking a lot about in our outlook, the ratchet effect.
Yep.
It's kind of like, I use the analogy, like once you give your kids an allowance, you can never give them less allowance. You have to keep giving them the same or more.
Well, inflation. Right.
Inflation. And now that we've done a lot of the stimulus, it's going to be hard to sort of undo a lot of this. Most expectations are to keep up with this.
Yeah.
So let's walk through this, and then we'll talk about the concept of stealth stimulus and other factors here. So take us through this summary here.
These are the big acts and plans that have been enacted since the onset of COVID. This is, up until infrastructure and Build Back Better, this is direct response emergency stimulus as a result of the pandemic. And so thinking about fiscal stimulus and fiscal spending on 2 different time horizons. There's one, the year-over-year change in fiscal spending, it's going to be down next year. Why? Because how can we possibly match what we've spent in 2020 and 2021? So the fiscal impulse next year, it's going to be negative. You could totally see how next year actually, because economic growth is year-over-year change, fiscal spending is going to be a drag on economic growth next year. So that's the base effect. Base effect is too high, can't beat it. Got it. But then that meets the ratchet effect, which now we're talking over a longer term time horizon. There are a lot of elements of stimulus and relief that were provided in response to the pandemic that are going to be sticky because a lot of them were very popular. And it's going to be very difficult to cut back a lot of that spending. So now you see the infrastructure bill and Build Back Better, which is the social spending climate change bill, which should be a vote mid-December on that. And these aren't apples to apples. Infrastructure and Build Back Better over the next 5 years, over the next 10 years, that money will be spent. Right. But you see there's this tendency, the ratchet effect is this tendency that after a crisis, after a big surge in fiscal spending, it's very difficult to reduce that spending going forward. And in fact, what you see is policymakers look for any excuse to ratchet up spending even after the original crisis is long gone. Mm-hmm. And we think we're starting to see the early signs of that.
Yeah, no matter which political party.
Exactly.
Doesn't matter.
Exactly.
So to talk about the concept of stealth stimulus mm-hmm. and what we're seeing at the federal level and at the state level.
Yeah. Another part of a lot of these bills and a lot of congressional activity since the pandemic has been granting certain municipalities, certain leaderships and policymakers sort of discretion to use stimulus if they deem necessary. Mm-hmm. Basically discretion to spend more money. And so you're seeing that. It's not baked into expectations, but for example, there are powers that by executive order, a lot of student loans could be forgiven. A lot of states and municipalities now have the authority and the discretion to distribute stimulus checks, very similar to what we saw for the CARES Act. And so, that's sort of the stealth stimulus under the hood.
And some states are actually doing that. And some student loans actually have been forgiven. And so you're seeing a lot of this happening under the surface while we still have a huge unemployment number and a low participation rate. And are we encouraging that to never recover?
Yeah, that argument can be made. That argument can certainly be made. The other side of that is, if you're an elected official and you're up for re-election, you're going to cater to your constituents, mm-hmm. and you're probably going to pull the trigger on that discretion and exercise that discretion quicker than you would have normally. Mm-hmm. Is it the quickest way to get back to full employment? No, probably not. Probably not. It would be tough to argue that.
Is it the beginnings of MMT?
So that's another good question. How do you finance this? We've been saying MMT it's not a thing that you're going to know.
Right.
Nobody's going to come out on Capitol Hill and say, okay, start that MMT thing now.
Right.
It's going to happen very slowly over time. It's sort of like, you don't want to put a negative connotation towards it, but sort of the frog in the pot, if you will. Mm-hmm. And so a lot of things are happening that will start to feel like MMT, and they'll get financed in a way that is MMT-like.
What's our outlook for December?
So December, it is somewhat dependent on ultimately what happens with Omicron. But our view is that, we're looking forward to earnings next year. Investors still have a lot of cash on the sidelines. Bonds still look very unattractive from a yield standpoint. So TINA is very much in effect. Mm-hmm. And so there should be dip buyers into the equity market. And if it ultimately turns out that Omicron is perhaps more transmissible, but also more mild, we think that would be actually a catalyst for a lot of dip buying. So relatively positive there. And
if we don't have lockdowns or some of the reactions that we've had in the past to this, it's mm-hmm. just more business as usual. You could still go to the college football games, root for your favorite team.
Yep.
Great. Well, thanks for the update this month, and thanks to our research staff for all these great slides.